special segment Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, Abhishek will tell us how Q3FY25 will be for the banking sector. Over to you, Abhishek.
To begin with, deposit growth on a year-on-year basis was at 9.9% at the end of Q3 FY25 and about 2.6% on a sequential basis. So YOY, the deposit growth is the lowest that you are seeing since March of 2023 as per RBI data. Advances growth was about 11.2% YOY and 3.6% sequentially. So loan growth has outpaced the deposit growth this time around as RBI has brought down the cash reserve ratio requirement for the banking sector in the previous MPC meeting. Hence, you saw the loan growth outpacing deposit growth this time by the end of Q3 FY25. Now, credit deposit ratio for the industry is at all-time high of about 80.5%, reflecting a more aggressive lending stance by the banking sector. Now, this augurs well in a high interest rate scenario for some lenders to maintain their net interest margin at healthy levels if at all they are able to curtail or contain their slippages. Now, net interest margin is expected to remain largely unaffected for most of the large lenders. We may see marginal decline for some of the lenders who have been aggressive on deposit growth, and net interest margin will also get impacted for lenders with higher slippages in Q3 FY25. Now, the net interest income growth over here is expected to be sluggish, particularly for PSU banks. So PSU banks have largely raised deposit rates at high cost while their loan growth is lower than the industry levels. On credit costs, certain sectors, especially those with unsecured lending like personal loans, credit card loans, as well as microfinance, they are expected to face higher credit costs in Q3 FY25. Now, this could be as a result of higher defaults and hence incrementally increased provisioning requirement for Q3 FY25. There is a need for more evidence to confirm whether these higher credit costs are stabilizing or not. Now, with respect to earnings outlook, overall earnings are expected to remain weak for the banking sector, particularly for PSU banks, because largely the treasury gains that they have had in the previous quarter will be missing this time. For some lenders, higher credit costs can impact their earnings momentum as well. Overall, earnings are expected to see weak momentum for the banking sector in Q3 FY25. Now, asset quality, while it may be generally stable for large players, concerns remain around the unsecured lending portfolios, which are expected to see continued deterioration like they did in the previous two quarters. X of unsecured loans, asset quality is largely expected to remain under control or see marginal improvement for the banking sector. We have some of the key estimates coming in from Kotak Securities. For HDFC Bank, they estimate NII growth of about 9% YOY, and for PAT, they estimate it to be at 16,591 crore, which is up 1% on a YOY basis. For ICICI Bank, the NII is expected to be up 9% YOY, and profit is expected to be up 14% YOY. For Axis Bank, the NII is expected to grow at 10% YOY, but profit to be up only 3% YOY. For SBI, the NII is expected to be up 6% YOY, and profit is expected to be up 59% YOY, but a decline of 21% nearly on a sequential basis. For Bank of Baroda, Kotak Securities estimates NII growth of 7% YOY, while profits are expected to decline by 13% on a YOY basis. Back to you.
Thank you very much for that. We will slip into a very short break. We'll come back with more on the market. Stay tuned.